All right, so we're diving in. We're really digging deep into the world of finance and investment. And now we're getting into how to measure and interpret those asset returns.
Yeah, exactly.
And we're looking at some excerpts from, well, from a textbook, really, on quantitative methods for asset returns.
Mm,
But don't worry, we're going to make it fun. We're not going to make this feel like homework.
that's right. The goal here isn't to, just bombard you with formulas.
Right.
We want to help you really grasp these concepts, these core concepts, and why they matter when you're actually making decisions as an investor.
So let's imagine you're looking at like
Yeah.
a whole bunch of investment returns, just a bunch of numbers.
hmm
Where do you even start? Like, what's the first thing you want to know to start making sense of this?
The first things to understand are central tendency and dispersion.
Okay.
Central tendency tells you where the returns sort of cluster around,
hmm
kind of like the average performance. But dispersion is equally important. Dispersion tells you how spread out the returns are, which gives you an idea of how much they fluctuate.
Wait, so is dispersion basically like the way to measure the risk? Like how unpredictable it is?
Yeah, exactly. The bigger the spread, the wilder the ride, basically.
Okay.
And for investors, that's crucial.
Yeah.
Because you want to know not just the average return you can expect, but also how bumpy the road might be to get there.
That makes a lot of sense. So the source material that we're looking at, it mentions these three different ways to measure central tendency: mean, median, and mode. Are they all like equally useful when you're trying to figure out investment returns?
Well, they each kind of tell you a slightly different story.
Mm.
The mean is just your simple average. You add them all up, divide by how many you have. It's helpful, but it can sometimes be a little misleading if you've got some extreme values in there.
Okay.
The median, on the other hand, is the middle value when you've got all the data lined up in order.
Yeah.
So it's not as sensitive to those outliers. And the mode is the most frequent return, which, to be honest, isn't really that helpful in most investment situations.
Okay, so let's say we've got like a group of portfolio managers and their 10-year annualized returns are like 30%, 15%, another 15%, 25%, 21%, 23%. Would the mean just be all of those added up and then, divided by 6?
Exactly. That's it. So in this case, the mean return would be about 21.5%.
Okay, and to find the median, would we just line those up in order and it'd be the one right in the middle? So here it would be between 21 and 23, so 22.
You're getting it. You're a natural. So here, the mean and the median are pretty close.
Yeah.
But things can get a little trickier when we throw in an outlier.
Ooh, okay, yeah, outliers.
Yeah.
That's interesting. So what if we add like a seventh manager who just had a crazy good year and earned 28%? How does that change things?
Well, if you add that manager with the 28% return, that would bump the median up to 23% because now it's the new middle value when they're all in order. But it also pulls the mean upward because the mean is more sensitive to those extreme values.
So the median, it gives you like a better sense of the typical performance because it's not like getting swayed by that one manager.
You got it. It's less likely to be skewed.
Yeah.
That's why it's important to look at both measures, I think. The median can be especially helpful when you're dealing with data that has outliers, which we definitely see with these investment returns.
Okay, so it sounds like these outliers, they can really mess with the numbers and maybe even paint a picture that's not quite accurate.
Yeah.
Is there anything you can do to, I don't know, like to tame them? Are there ways to like adjust for those extremes?
There are actually. There are a couple techniques that our textbook talks about. One is called a trimmed mean, and the other is called a Windsorized mean.
Those sound pretty intense. What are those about?
So a trimmed mean is kind of what it sounds like. You're trimming off the rough edges of the data, so you discard like a certain percentage of the highest and lowest values before you calculate the mean. So like a 10% trimmed mean, you would throw out the top and bottom 10% of those data points.
Okay. So you're just kind of focusing on the more normal, average, whatever you want to call them.
Exactly. Focusing on the more typical, the more middle values.
Okay. So you're ignoring the outliers. What about the Windsorized mean? What is that?
A Windsorized mean is similar, but instead of completely discarding those outliers, you replace them with less extreme values. So, for example, in a 90% Windsorized mean, you would replace like the bottom 5% of the values with the value at the 5th percentile and the top 5% with the value at the 95th percentile.
So you're not ignoring them, but you're kind of like, reining them in a little bit.
Exactly. You're sort of capping them so they don't have as much of a huge impact.
Okay. But so why should I care about all of this stuff with the outliers and all that? Like, how does that affect me as an investor?
Well, it can help you get a more realistic picture of the potential performance. Like,
Hmm.
imagine you're evaluating a fund that, had one incredible year just because of some some lucky break or a one-time event.
Yeah.
The mean return might look amazing,
Yeah.
but if you don't account for that outlier, you could be you could be overestimating what that fund can really do.
So it's kind of misleading. It's painting like a rosier picture.
Exactly.
Yeah. Okay. That makes sense. Okay. So we've been talking a lot about central tendency, the mean, the median, all that.
Right.
But what about the other side, like the dispersion? How do you actually measure, that spread, how risky those returns are? Like, give me the tools here to quantify that risk.
Okay, so one really simple way is just to look at the range, which is the difference between the highest and lowest values in the data set. But to get a more a more nuanced understanding, we need to dig into measures like the mean absolute deviation, or MAD, and variance.
Oh, MAD and variance. Okay, those sound more sophisticated.
They are.
Tell me about those. What are those all about?
So MAD, it gives us like the average distance of each data point from that mean. It doesn't care if the difference is positive or negative. It just tells you like how far off each return is from the average. Variance, on the other hand, takes the average of the squared deviations from the mean.
Hold on, why do you have to square them? Why not just use the regular differences?
Squaring those deviations actually does a couple of important things.
Okay.
First, it makes sure that we're only looking at how big those deviations are and not whether they're above or below the mean.
Okay.
And second, it gives more weight to the larger deviations, which helps to really highlight how much those outliers are affecting things.
Okay, I think I get that. So these are giving you like a much more detailed picture than just looking at like the simple average. But can we walk through like an example with some actual numbers? Sometimes that helps me understand it better.
Yeah, of course. Let's go back to our 5 investment managers with the returns of 30%, 12%, 15%, 20%, and 23%.
Yeah.
So calculate MAD. First, we find that mean return, which we already did. It was 19%.
Yeah.
And then for each of those returns, we just we calculate how far away it is from that mean, ignoring whether it's above or below. So we'd have 11%, 7%, 4%, 1%, and 4%.
Okay, so those are like the absolute differences. Yes.
Exactly, the absolute deviations from that mean.
And then what do we do with those?
We just average them, add them up, divide by 5.
Okay.
And that gives us a MANDI of 5.4%.
Okay.
Which means that, like, on average, the returns for those managers are about 5.4 percentage points away from that average return.
So it gives you like a measure of how much those returns are bouncing around.
Yeah, a kind of typical amount of spread.
Okay, what about variance? How do you calculate that?
Okay, so for variance, we take those deviations that we just calculated,
Yep.
we square each one, then we add them all up, and we divide by the number of observations minus 1. So in this case, we divide by 4 instead of 5. And that gives us a sample variance of 44.56%.
Okay, why do you divide by like 1 less than the total? Why not just divide by 5?
That's a good question.
Yeah.
Dividing by n1 instead of just n, that's a statistical thing, a little trick, and it gives us a more accurate estimate of the real variability in that whole population of managers, even though we're only looking at a sample of 5 of them.
Oh, so it's like adjusting for the fact that we're only seeing part of the picture.
Exactly.
Okay. But I gotta be honest, like, dealing with squared percentages, that seems a little abstract to me.
Yeah.
Is there a way to get back to something that's a little more intuitive to understand?
Yeah, you're right. Squared percentages aren't the easiest thing to visualize.
Yeah.
That's where standard deviation comes in. Standard deviation is just the square root of that variance. So it gives us a measure of that dispersion, but in the same units as the original data, which in this case is percentages.
So in our example where the variance is 44.56%, the standard deviation would be?
It would be the square root of 44.56, which is
Yeah.
about 6.67%.
Okay.
So what that means is, on average, the returns for those managers are within, roughly 6.67 percentage points above or below that mean return of 19%.
Oh, that makes more sense to me. I can visualize that spread.
Yeah.
Okay, so this is starting to get really useful, but what if I'm comparing investments that have different average returns? Like, how do I know which one is riskier if they're on different, like totally different scales?
That's a great point. When you want to compare the risk of investments that have different means, you need a relative measure of dispersion.
Okay.
And that brings us to the coefficient of variation, or CV.
CV, okay.
It's calculated just by dividing the standard deviation by the mean.
So it's telling you how much risk you're taking for every unit of return you expect to get, kind of a risk to reward ratio.
You got it. And a higher CV indicates greater risk per unit of return.
Okay.
So let's say, for example, we're comparing monthly returns on T-bills, which are super safe, to the S&P 500, which is more volatile.
Right.
So let's say the T-bills have a mean return of 0.25% with a standard deviation of 0.36%. And the S&P 500 has a mean return of 1.309% and a standard deviation of 7.30%.
So to find their CVs, we just divide the standard deviation by the mean for each of those.
Exactly, yeah.
Okay. So for T-bills, that would be 1.44, and for the S&P 500, it'd be 6.70. Wow, that's a big difference.
Right, so what that's telling you is even though the S&P 500 has a higher average return, you're also taking on a lot more risk per unit of return compared to those T-bills.
So a lower CV means lower risk per unit of return?
Generally, yeah.
Okay, I'm getting that. But, these traditional risk measures like standard deviation and the CV, it seems like they treat upside volatility and downside volatility like the same, right?
Yeah, that's right.
But what if I'm more worried about like the losses than the potential for big wins?
Yeah.
Isn't there like a way to measure that specific downside risk?
Yeah, you're right. That's one of the limitations with those traditional measures. They don't differentiate between, good volatility and bad volatility.
Yeah.
And for a lot of investors, the chance of losing money matters more than the potential for some huge gains.
Right.
And that's where target downside deviation comes in.
Okay.
It focuses specifically on the downside risk, the variability of those returns that fall below a certain target return that you set.
So it's really laser focused on like the stuff that keeps investors up at night.
Exactly.
Yeah. Okay, I like that.
So let's say we go back to our 5 investment managers, and this time we set a target return of 22%. To calculate target downside deviation, we'd only look at the returns that are below that 22%.
So in that example, we'd only look at the 12%, the 15%, and the 20% returns because those are all below our target.
Exactly.
Yeah.
Yeah. And then we figure out how far away each of those returns is from our target. So, for example, 12% is 10 percentage points below 22%, right?
Mm-hmm.
So we square those deviations, add them all up, divide by, again, n1, so 4 in this case.
Mm-hmm.
And then finally, we take the square root of all that to get the target downside deviation.
So it really gives you that like more realistic sense of what the potential downside could be.
Yeah, more specific.
Especially if you're an investor who's more worried about like avoiding losses than hitting a home run.
Exactly.
This is great. Okay, so we've covered a lot here. Simple averages and this target downside deviation. But is there more? Like can the shape of that return distribution, how those returns are spread out, can that tell us anything important about the investment?
That's a great question. And yeah, the answer is definitely yes.
Okay.
The shape of that distribution can give you some really important insights into the nature of those returns. And skewness and kurtosis are 2 measures that can describe that shape.
Okay, hit me with it. Skewness and kurtosis. What do those tell us? How do they help me understand an investment better?
So skewness measures how symmetrical the distribution is. Is it leaning to one side or the other?
Mm-hmm.
A perfectly symmetrical distribution, like that classic bell curve, has 0 skewness.
Yeah.
But if the tail of the distribution is stretching out more to the right, meaning there's more of those big positive returns, we call that positive skew or sometimes right skew. And if it's the other way around, with the left tail being longer, meaning you got more of those big negative returns, that's called negative skew or left skew.
So if you're an investor who's like hoping to hit the jackpot, you'd want a positively skewed distribution, right?
Yeah, you would. A positively skewed distribution might be attractive to investors who are really looking for those big returns, but it's important to remember that it also comes with a greater risk of significant losses as well. It's a higher stakes game.
Higher risk, higher reward.
What?
Okay, I get skewness. Now what about kurtosis? What does that tell us?
Kurtosis, it measures how peaked or tailed the distribution is. So a distribution with high kurtosis, it's got a sharper peak and fatter tails than that normal distribution. We call those leptokurtic distributions.
Okay, so in like regular terms, what does that mean? Like if I see an investment that has high kurtosis, what should I be thinking?
Well, it means that there's a higher probability of those really extreme events, both positive and negative.
Yeah.
It's like playing a game where the dice are loaded. You might get lucky and see a huge win, but there's also a bigger chance of a major loss.
So a So a leptokurtic distribution basically means there's a higher chance of those black swan events, those unexpected extreme events that kind of come out of nowhere.
Exactly. Understanding kurtosis helps you kind of assess the likelihood of those outliers happening so you can adjust your risk management strategy accordingly. It's all about knowing what you're getting into.
Okay, so this is really cool. We've gone from simple averages to black swan events. And it's all connected.
Yeah.
But we're not done yet, are we? There's still more to this story about asset returns.
Yeah, there's one more really key concept we need to talk about, and that's correlation.
Correlation, okay.
Correlation, it measures how two variables move together.
Okay. I've seen like those scatter plots before with like all the dots all over the place.
Right.
How do those fit into all of this?
Scatter plots are a great way to actually visualize correlation. If all those dots cluster really tightly along an upward sloping line, that suggests a strong positive correlation. A downward sloping line means there's negative correlation, meaning those variables tend to move in opposite directions. And if the dots are just kind of all over the place, that means there's a weak or non-existent relationship.
So correlation, it tells you how closely like two things are moving together. Are they in sync or are they doing their own thing?
Yeah, exactly.
But why is that so important for investors? How does understanding correlation help me make like actual better decisions?
Well, it's the foundation of diversification, which is one of the key ways to manage risk in your portfolio. By combining assets that have low or even negative correlation, you can potentially reduce the overall risk of your investments.
That's why they say, like, don't put all your eggs in one basket.
Right, exactly.
If one investment goes down, hopefully the other one will either stay the same or go up and kind of balance things out.
Yeah, diversification isn't just about, spreading your investments around randomly. It's about strategically combining assets that behave differently in different market conditions.
Yeah.
And understanding correlation, that gives you the insights to do that effectively.
Okay, I see how this is all fitting together. But before we move on, we were talking earlier about how correlation doesn't always equal causation. Like there could be those hidden factors at play that create this connection that's not really there. But are there ever times when correlation can give us like a clue about causation, even if it's not like definite proof?
That's a really great question.
Yeah.
And the answer is yes. Sometimes correlation can actually be a starting point for figuring out if there really is a cause and effect relationship between two things.
So it's like a breadcrumb trail kind of leading you to a potential explanation.
Yeah, that's a good way to put it.
But you still got to do more digging to see if it really holds up.
Exactly. If we see a strong correlation between two things, it might make us wonder, like, is there a logical reason why they're moving together?
Yeah.
It gives us a place to start investigating.
So let's say, we see the strong correlation between a company's earnings growth and its stock price.
Right.
That correlation, it might make us, want to dig in further and see, like, is that earnings growth actually driving investor confidence, which then, pushes up the stock price.
Exactly.
Yeah.
Correlation can be a really valuable tool for for having those aha moments.
Yeah.
And giving us kind of a direction for further research. But it's just one piece of the puzzle.
Got it. Correlation can be a clue, but it's not the whole story.
Right.
You got to put on your detective hat and look for more evidence.
You got it.
So we've covered a ton of ground here, from central tendency and dispersion to correlation. And we've seen how understanding all of these statistical measures, they can help us as investors to make more informed decisions. But if our listeners were to take away just one key message from this whole discussion, what would it be? What's the most important thing to remember?
I think the most important takeaway is this. Understanding asset returns is about more than just looking at, the average return. It's about really understanding the concepts of risk and variability and how different assets kind of behave in relation to each other.
So it's not just about how much money you might make. It's also about how much you could lose and how likely those different outcomes are, both the good and the bad.
You got it. By using those statistical measures, you can really paint a more complete or more realistic picture of the potential of that investment. And with that knowledge, you can make more informed decisions that actually align with your own risk tolerance and your investment goals.
That's a That's a great way to put it. Knowledge really is power, right? And understanding these statistical concepts, that can give investors a huge advantage in making those smarter choices. But before we wrap up this part of our deep dive, I have one final thought to throw out there for our listeners to ponder.
Okay, you've hit on a really important point.
Yeah.
Just because two things are correlated doesn't automatically mean that one is causing the other to change.
Right.
There could be some hidden factor at play that's influencing both. And that's what we call a spurious correlation.
Spurious correlation, huh? Okay, that sounds kind of mysterious.
It is. It's kind of like a statistical illusion.
Okay.
Can you give us like an example?
Yeah, an example would be great because I'm having trouble picturing like how that would actually work.
Sure. Imagine you notice there's like a really strong positive correlation between ice cream sales and shark attacks.
So does that mean like people buying ice cream are somehow attracting sharks?
That would be terrifying.
Yeah, I love ice cream, but I don't want to run into a shark while I'm eating it.
Right, me neither.
Yeah.
I think the real connection is probably something else entirely, like summertime.
Summertime, okay.
Yeah, hot weather, leads to increased ice cream sales and more people swimming in the ocean.
Right.
Which unfortunately means there's more chances of those shark encounters.
Ah, okay, so the correlation is real. Those two things, they do tend to go up and down together, but it's not like one is directly causing the other to happen.
Exactly. It's not a cause and effect relationship. It's just that they're both influenced by this third factor, the summer heat.
Okay, so correlation isn't always causation. That's a really good takeaway.
It is. You got to be careful.
But let's bring this back to like those investment returns we were talking about. We've covered how to measure them, how to understand their spread, and even how they move together.
Right.
But for me, like as an investor, what does it all mean? How can I actually use this knowledge to make smarter decisions with my money?
Well, all these statistical measures, they can be really helpful tools when you're comparing different investment opportunities.
Okay.
So, for example, let's say you're looking at two different mutual funds, and they have like similar average returns.
Okay. On the surface, they seem pretty comparable.
Yeah. But if you dig a little deeper and look at their standard deviations, you get a sense of which fund's returns are more volatile. A higher standard deviation means those returns are bouncing around more, which could mean a wilder ride for you as the investor.
So if I'm like a more cautious investor, I might prefer the fund with the lower standard deviation, even if the average return is, a little bit lower.
That's a really good point.
Yeah.
It really depends on you as an investor. What's your risk tolerance?
Yeah.
What are your goals?
Right.
If you're okay with more ups and downs, because you're hoping for those potentially higher returns, then maybe the fund with that higher standard deviation is a good fit.
Yeah.
But if you're more focused on stability and protecting your money, then yeah, that lower volatility option might be a better choice for you.
Okay, so it's all about finding that balance
Yeah, finding what you're comfortable with.
between risk and potential reward. This is making me think about like my own portfolio. I've got, a mix of stocks and bonds in there, and I know that diversification is important.
Right.
But I'm realizing now that correlation plays a big role in making that diversification actually work.
Absolutely. Diversification is about more than just, spreading your money across different asset classes.
Yeah.
It's about strategically combining those assets in a way that, helps to smooth out the bumps along the way.
So, for example, stocks and bonds, they often have like a low or even a negative correlation, right?
Exactly.
So when the stock market takes a dip, bonds might hold steady or even go up, and that helps to kind of cushion the blow to your overall portfolio.
That's the idea. You want to build a portfolio that can weather those inevitable market storms.
So understanding those correlations, it's like having a secret weapon.
It is. It's one of the keys to successful investing.
Okay, I'm seeing how this all ties together. We haven't talked too much about skewness and kurtosis lately, though.
It's true.
Where do those concepts fit into all of this? Like, do I need to be thinking about them when I'm, evaluating different investments?
Those are definitely things you should be thinking about. Remember how we talked about skewness and how it can show you those, asymmetries in the distribution of returns?
Yeah.
Well, a positively skewed distribution with that long right tail, it suggests that there's potential for those really big gains, but it also means there's a greater risk of some pretty big negative returns too.
So if I'm an investor who's a little more risk averse, I might want to be careful about investments that have that high positive skew.
Right.
Even if they're tempting me with those possibilities of huge wins.
It's a trade-off, right?
Exactly. And what about kurtosis? How does that play into things?
Well, kurtosis, it highlights the likelihood of those, those extreme events, both positive and negative. So if you see an investment that has high kurtosis, it's kind of like a warning sign that there's a greater chance of those unpredictable, those outsized moves in either direction.
So basically, high kurtosis means buckle up, buttercup. It's going to be a bumpy ride.
Yeah, you could say that.
Okay, this is all making a lot more sense now. Are there any limitations to all of these statistical measures, though?
That's a really good question, and an important one to think about. Remember, all of these measures, they're based on historical data.
Right, past performance doesn't guarantee future results.
Exactly. And market conditions can change, and the relationships between different assets can change too. So while these measures are powerful tools, they should always be used alongside other types of research and analysis.
So don't just blindly plug the numbers into a formula and call it a day.
Right, you got to look at the bigger picture too.
Okay, got it. So we're not robots. We need to use our judgment and our common sense along with these statistical insights.
Exactly, the numbers, they give you a framework, but the ultimate decision should be based on, a holistic view of the investment landscape.
And taking into account like my own personal situation.
Absolutely.
Okay, that makes sense. So we've covered a lot here, from central tendency and dispersion to correlation skewness and kurtosis.
Right, we've gone deep.
And we've seen how understanding all these statistical measures can help us be more informed and confident investors. But as we kind of wrap up this part of our deep dive, what's the one key message you want our listeners to take away from this?
The financial markets are complex. There's no doubt about that. But these statistical measures, they're really valuable tools for understanding how investments work. But you have to use them with a healthy dose of caution and critical thinking. They're just one piece of the puzzle.
So it's not about blindly following the numbers. It's
Yeah.
about using those insights as part of a broader understanding of the market.
Exactly. And always keeping in mind your own personal investment goals and your own risk tolerance.
Don't forget about the human element.
Right. You're not a spreadsheet.
That's a great point. The key is to stay curious, keep learning, and never stop questioning.
I agree with that.
The more we understand about how these asset returns work, the better we'll be able to navigate this whole world of investing and reach our financial goals.
Well said.
Thanks for joining us on this deep dive into the world of asset returns. We'll be back next time for another exciting exploration of the world of finance and investing.
So we were talking about how correlation doesn't automatically mean causation.
Right.
Right.
Yeah.
Like there could be those hidden factors that are creating a connection that's not, not really there. But are there ever times when correlation can actually give us a clue about causation, even if it's not like, definite proof?
Yeah, that's a really good question. And the answer is yes. Sometimes correlation can be like a starting point for figuring out if there's a real cause and effect relationship.
So it's like a breadcrumb trail.
Yeah.
Like leading you to a potential explanation. Yeah.
That's a good way to put it.
But you still have to do more like investigating to see if it really holds up, right?
Exactly. If we see a strong correlation between two things, it might make us wonder, is there a logical reason why they're moving together?
Right.
And that gives us a place to start digging a little deeper.
Okay, so let's say we notice there's a really strong correlation between a company's earnings growth and its stock price.
Okay.
That correlation, it might make us, want to dig in further and say like, okay, is that earnings growth actually driving investor confidence, which then in turn, pushes that stock price up.
Exactly. Correlation can be a really valuable tool for generating those those aha moments.
Yeah.
And giving us a direction for further research. But it's just one piece of the puzzle,
Got it. So correlation can be a clue, but it's not the whole story.
Right.
You gotta put on your detective hat.
You got it. And look for more evidence.
Well, this has been an incredible journey. I mean, we've learned so much from those basic concepts like the mean and standard deviation.
Yeah.
All the way to these more nuanced ideas like skewness and kurtosis and correlation.
Yeah, we've covered a lot of ground.
And we've seen how understanding all these different statistical measures, they can really empower us as investors to make these more informed decisions. But as we wrap up this deep dive, what's the one key message you hope our listeners will take away from all of this?
I think the most important thing to remember is this. The financial markets are complex, there's no doubt about it. But
Mhm.
these statistical measures, they're really valuable tools for understanding how investments work.
Hmm.
But you got to use them, with a healthy dose of caution and critical thinking. They're part of a bigger picture.
So it's not about like blindly following formulas or relying just on that historical data.
Yay. It's about using these insights as part of like a broader understanding of the market.
Mm.
And we're always keeping in mind, our own individual investment goals and risk tolerance.
Absolutely. The key is to stay curious,
Yeah.
keep learning, and never stop questioning.
Yeah.
The more we understand about how asset returns work, the better equipped we'll be to navigate this whole exciting world of investing and actually achieve our financial goals.
That's a great message to end on. Thanks for joining us on this deep dive into the world of asset returns. We'll see you next time for another fascinating exploration of the world of finance and investing.